Hi traders, welcome to Market Outlook, Trends, Risk, Events and Trade Setups brought to you by Vantage Markets. This is our weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. Whilst I'll just let you have a look at the disclaimer as usual, I'll just run through some of the areas that we will focus on this week. We'll follow the usual format. In fact, we'll obviously check out how markets are shaping up today. It's a US holiday, remember, Martin Luther King Day in the States. So US markets are closed, just to remind you. But we'll look at markets generally, how they're shaping up. Stocks, of course, look at the technicals around stocks and some of the highlights of the earnings season so far with US banks reporting last week. It's a lighter calendar actually on the earnings season front this week. Before then, we get some of the mega caps reporting next week, Apple, Amazon, and some of those other tech titans. That is next week. So a lighter calendar for this week, but we'll just talk around a few thoughts around that and earnings potentially affecting the technicals then, which we'll look at for the major US indices. Also, we'll touch upon this outperformance that we've been seeing of European stocks over US stocks over the last few months, actually, since that bottom in October, when news was obviously very grim about Europe, and they've certainly picked up European stocks. And we've been sort of highlighting this really over the last few weeks, especially. So we'll just touch upon that before then moving on to a brief review of the US CPI data, exceptionally important figures out of the US last week. So we'll focus on that, some of the drivers there, and then price action in the dollar, the DXY. And then we'll move on to the highlight of the week. No doubt, the Bank of Japan policy meeting on Wednesday, which we'll look at in detail, really, go back to basics on some of it, certainly the yield curve control policy, YCC policy, which is getting a lot of attention. We'll just kind of try to break that down slightly, just so that we're all sort of understanding what that is, the impact of that, only briefly, so I won't get too technical for sure. And any questions you do have, please ask away. And then we'll finally wrap up, hopefully, with a look at UK data. It's the usual mid-month UK data dump, we call it, on our daily market commentary. That is generally the middle part of the month. The UK sees jobs data, it sees the inflation data, and also retail sales on a Friday, always generally in the middle of the month. Potentially that UK CPI data, especially on Wednesday, will be a driver for sterling going forward. And the MPC meeting at the start of February. Just to highlight, actually, that first week in February, if you haven't looked at the calendar already, has the FOMC meeting. It's a bit like December, actually. So it has the FOMC meeting on a Wednesday night, UK time at least. And then we get the ECB and the Bank of England the following day. I think we had US CPI actually in that week of December, but at least we've got those three major central bank meetings within a sort of 48 hours probably of each other. Less really, actually, 30 hours probably or so on that first week in February. So not long to that. I know some banks are already looking forward to that and writing about some of the impact potentially. And we'll talk about it in the next 40 minutes or so. Okay, generally markets this week, before I get on to this outperformance of European stocks, markets generally pretty quiet. We had further gains in US stocks on Friday, though sort of relatively modest scale really as a boost from that low inflation data earlier last week, sort of slightly began to fade. Certainly some of the pop, if you like, in the bond markets, that's faded slightly as well. We've highlighted the 10-year US Treasury yield and the 3.5% marker being key psychological level, probably technical level is just below that, 3.42%. That's the US 10-year Treasury yield, but 3.5% always gets notice, and that's where we are currently trading at the moment. As I said, it's a public holiday in the US, so their markets are actually closed. So generally, probably markets will be probably slightly uninspired today. Still movement, though, of course. Euro dollar, it is drifting a touch lower, but still remaining above 108. And most of the rest of the G10 pack, actually the FX G10 pack, is pretty stable, pretty steady. Exception probably being the yen, of course, which is grabbing all the attention and has been for quite a few weeks now. Lots of support from investors betting on this change in policy, potentially at Wednesday meeting. We'll go into that in a lot more depth. Not sure really, because none of the consensus of forecasters actually who watch the Bank of Japan a lot, of course, they don't think the Bank of Japan will actually move. But of course, no one wants to really miss out by being on the wrong side of any surprise on either that monetary policy change, that yield curve control change, or of course any change on policy rates. And the 10-year yield in Japan on their JGB, the government bond yield, that remains actually above their recent change in that band above, so 0.5%. I said we just touch on the Fed briefly. I think it's interesting reading a lot about what happens after we get to the peak rate in the Fed funds rate. That is sort of oscillating around 5%, just below 5%. Obviously, the Fed speakers recently been talking about 5.1%, that being the median dot plot from the December FOMC revision in their dot plots, seeing the peak at 5.1, market still below that. And then really quite quickly pricing in a couple of cuts, a couple of 25 basis point cuts by next January. And it's interesting, really, we think that the whole idea around rates sort of stopping going up, of course, but then there's nothing to say they have to come down. And this really depends on growth. It really depends on inflation, how sticky that number is, how quickly it comes down, as we've been saying. A lot, of course, depends around that on economic circumstances. And in some ways, the market sort of sees that terminal peak rate as light at the end of the tunnel, really, of this hiking cycle. Although really, it is the next or the first step in the shift towards easing. But the closer we get to the terminal rate, then potentially the more the market kind of may view the Fed actually as a kind of source of support rather than a risk. But then the focus is kind of what we're trying to say here. The focus may shift then from the Fed to really that obviously has been the major driver of markets, inflation, and then the Fed policy tightening, most aggressive we've seen in many decades, as we've highlighted recently. But then it's about potentially this year how much and how fast growth slows. And it's again this balancing act, this threading a needle. We can't reiterate it enough, really. Then looking at the data, because that will then drive inflation, the Fed, of course, rates, earnings, of course, and then ultimately markets. Okay, just a sort of thought that we normally have after briefly looking at how markets are shaping up. Just looking at equities, then US stocks. They notched their largest weekly gains in 2 months, actually, as earnings season kicked off last week. Traders really, we took the economic indicators showing easing inflation as a sign that the Fed, of course, won't be as aggressive in raising rates this year. Wall Street's S&P 500, that rose 0.4% on Friday, taking the weekly gains to 2.7%. The NASDAQ, that climbed 0.7%, taking gains over the previous 5 sessions to nearly 5%. So the indices really had their largest weekly advances since mid-November. and they also notched back-to-back weekly gains following 4 weeks of consecutive losses. We'll get into some of the technicals to show you that on the charts, of course, but certainly focus is now on earnings. They stepped up a gear on Friday, kind of mixed set of results really from some of the America's biggest investment banks, really, finance groups. Year-on-year net income inched higher at Bank of America and JP Morgan, whilst Wells Fargo's quarterly profit halved from a year ago, essentially due to great big fines that they're having to endure. BlackRock, that's a big asset manager, that reported a 15% decline in revenues. So although investors are weighing the medium-term outlook, of course, for the sector against the debate about potential recession this year, lenders really, these kind of finance groups, have broadly benefited from the Federal Reserve's aggressive campaign to raise interest rates. And then, of course, we get into concerns in the market over this looming recession potentially, which has meant analysts last year, of course, lowered their EPS estimates, their earnings per share estimates for the S&P 500 companies actually by 6.5% for the fourth quarter. And that's a larger margin than average. As I said, the calendar is light for Q4 earnings this week, really, especially compared to next week, as I said, with some of those massive tech companies reporting. The key uncertainty is credit quality into 2023, as it's linked certainly to the degree of a recession. We do get, I was just looking at the calendar, sorry, we do get former high flyer Netflix this week. We do get a couple of other banks, investment banks on Tuesday, Goldman Sachs and Morgan Stanley. A lot of focus, of course, will be on Netflix, a darling really of the markets. It has achieved a more than 100% rally off its 2022 lows, actually coming into this week's report. Even if it trades at under 50% of its peak valuation back in late 2021. So just looking at technicals, yeah, I've got this chart here, European outperformance over the US indices, over the S&P 500. You can see there, sort of tracking, the light blue line is the sort of broader market for the Europe, the Euro Stoxx 600. That's the biggest companies in Europe. That's tracking against the biggest in, well, the US, the S&P 500. And you can see there just sort of December time, November, December time, where it was sort of similar performance. And then you can just see this widening really where US stocks sort of track sideways through December, European stocks as well, but then they picked up quicker, should we say, and have really outperformed. Just looking at that Euro Stoxx 600, then that's actually up 18% since the September bottom. That's against just over 9% for the S&P gains. The DAX, the German index of the 30 biggest companies in Germany, that's up 7% or so this year, and gains over the past 3 months are greater than now 20%. Similar for the CAC, I think the French CAC 40, that's up around 7% this year as well. FTSE's doing well, of course, hitting fresh 2-year highs. Generally, when we look to that market last week, especially fresh 2-year highs, most days actually last week. So really interesting outperformance. We've talked about it before, really. Gas prices are being lower. That's easing the pressure on the ECB, certainly to ratchet down from the 75 basis point hikes that we've seen. And then, of course, we've had the China relaxation in the zero COVID policy, which has really helped Europe. China's the biggest trading partner for the region, and that has really boosted sentiment. and the outperformance of stocks. Where that goes from here, well, certainly kind of seems as though a lot of good news is now in the price potentially for some of these European indices. Before that, let's just look at say the DAX, which we've looked at before. You can see we're kind of overbought again on the RSI, on the daily. If we just go to the weekly, you can see we're not overbought actually on the weekly index. You can see those great big, really good moves for this year. And we sort of posted the next fib level probably of the last year's downtrend really is at 78.6. So the final sort of fib level, minor fib level compared to probably the 61.8, but that's at 15,334. You can see on the DAX there, kind of probably next level we have. And then support is around that 100-week moving average, 14,601. Just below there, 14,581 is the 61.8 fib level. On the daily, you can just see, the sort of tracking sideways, the move lower through December, but then this consecutive, really strong bullish momentum really through this year. You can see those consecutive candles there and these green lines being up days, of course, but potentially heading into overbought territory, certainly on the sort of shorter term charts. With resistance just above at 15,300, just above there. That's on the DAX. If we just look at the S&P now, critical level for the S&P, and real focus is now on this zone. We've highlighted it quite a lot, really. 4,000, of course, is a key psychological level, but then it also tallies with the 200-day moving average, that thick black line, that's at 3,981, you can see. And then we have, of course, that downtrend, trend line resistance, if you like, the downtrend from that top back in January, touching quite a few levels, so reinforcing that point, and a really critical level. If we just move to the weekly, actually, you can see we closed near the highs, so very strong close really last Friday, near the highs, always psychologically important and technically as well. So potentially if we do push above here, then we have these pivot highs from December around 4,100 that you can see there. So that's the next upside target if we can break above this sort of resistance zone, this psychological level. If we do 4,100, as I say, the next upside level, and then above that, probably that sort of September high reinforces that 4,100 level. Before then, we probably go to round numbers and 4,200. You can see there the August highs, late August highs. And that means then that support would, that resistance, which is around 4,000 at the moment, potentially, that becomes support. The NASDAQ, the tech index, tech laden index, really, that has more work to do, as you can see on the chart. Really some catching up to do. So we're only traded just above the 50-day moving average that you can see at 11,365. That's that light blue line. And now we're touching, actually just closed strongly, similarly strongly on the Friday, a close which touched the 100-day moving average. That's at 11,523, you can see. But we're still below that falling trend line, and we're sort of 600 points below the 200-day moving average on the NASDAQ 100, which is at 12,134. So sort of some way to go really for the NASDAQ to catch up. We've said that really, if tech stocks, growth stocks do start to potentially outperform, then the NASDAQ certainly will go up, and certainly then we would break that 4,000 level in the broader benchmark, the S&P 500. Just looking at the Dow, which has sort of, as you know, older economy stocks, then we're back to this 34,281 level we have from the August high there, which we sort of pushed above briefly in December, but couldn't sustain any gains above that. So again, an important level. The high from December actually 34,712. So a few hundred points there of resistance potentially. That's in the Dow, but as you can see, if we do push higher, then we haven't got the 70. The next fib level, but we've got probably, the April level 35,492 potentially as a next upside target if we can push above. So really interesting levels here for some of these major stock indices. Now we'll just go on to just a quick review of the US CPI data. Always important, we think, to review some of this key big data which drives markets. Of course, we've got the graphic here with those sort of key numbers and just some points around those key numbers. Essentially a further slowdown in US inflation, the headline sliding to 6.5% from the expected, hit. It was in line with the expectations of 6.5%, but that slid from the 7.1% in November, stepping into disinflationary territory really on the month-on-month reading. That came in with a negative 0.1% print from the plus 0.1% previously. Core inflation, well, just before we get to that, you can see lowest reading in over a year, really. Remember, 6 straight months of declines in that headline. For core, so that strips out those volatile energy and food costs. That also eased in line with expectations at 5.7% from 6% previously. But still higher on the month-on-month basis, 0.3% from 0.2% in November. We should obviously remember the deceleration continues after the headline, at least that peaked at 9.1% in June. And the core, that peak was at 6.6% in September. Just to sort of bear in mind amongst this sort of optimism around these falling inflation levels, we still aren't below the, I think economists talk about a 0.1% month-on-month threshold that over time would then get us to the Fed's 2% year-on-year target. Even though obviously the last 3 months of data have been a notable step down from, if you remember, the 0.5 to 0.6% month-on-month averages that we had seen through the second and third quarters of last year. So still a little way, certainly a way to go. Falls were due to the steep drop in petrol prices, down 9.4% and now down 1.5% over the past year. This more than offset services inflation, which was still higher, being the more sticky component of inflation, if you like. And that's been driven by higher shelter costs. We've highlighted that quite a few months ago, how they were rising and going higher, plus 0.8% month on month in this report, plus 7.5% year on year. But then against that, we've had most wage sensitive components kind of showing easing price pressures. But certainly shelter, well, it's high, but it's a lagging data point. So it is actually seen falling sharply later this year, reflecting the steep drop in house prices and also a leveling off of rental increases that have occurred. But those changes take some time to show up into these stats, typically 6 to 9 months, actually. So that is something to bear in mind. Certainly, some economists looking through the data, looking through those rises in shelter costs because they see them coming down. Other economists have a different view, still see them elevated. But all in, certainly 6 consecutive months of softening in inflation in that headline number especially. And the Fed really will take some comfort from the tightening moves that they have put in place, of course. Policymakers, certainly they've said that they're paying close attention to that services inflation that we've just talked about, and that's closely tied to the labour market. So again, if we recap, wage growth we saw recently slowed from its peak, but there are still, of course, decent job gains, 200,000 or so, and the unemployment rate, of course, still hovers around multi-decade lows. And certainly from the policymakers' side, the concern is that services-related price pressures will potentially be harder to root out and therefore require very low growth and higher unemployment. Interestingly, following the CPI release, we had a few Fed speakers. Actually, we had Harker, who's a voter, and Barkin, a non-voter. They favoured slower rate hikes from here, and Harker, was eager actually to look past that shelter increase, as mentioning basically that lower costs take time to show up in the data. As we've kind of mentioned, economists therefore split, some thinking easing financial conditions, less negative growth outlook, and the economic recovery in China, they'll create persistent inflation risks, meaning that inflation is sort of sticky, stays elevated for longer. And they then think policy rates are going to above 5% in May, whilst others think that the latest CPI report at least adds more weight to the view that CPI will fall more rapidly than the Fed expects. But certainly it's evidence around this easing in labour market conditions and wage growth that may take a few more months before then evidence is kind of indisputable, and then the Fed's rhetoric, we've mentioned this before, if that then changes markedly, if they're happy that wage growth is abating at least, then certainly that will impact markets even more, we think. Pricing in money markets then, that took another step down at the Fed's next decision, February 1st, as we mentioned, 25 basis points now. The rate hike it has kind of moved, I think, to above 90% chances of that happening, pretty nailed on really, from around 75% before the CPI release. Expectations after that are for one more 25 basis point hike in March. But then, as we've kind of mentioned, both those hikes then are forecast to be reversed by year end. And then that terminal rate sort of oscillates around the 5% level, is now sub 5%, as it has been, in contrast to what Fed speakers are generally saying. For the dollar, we just look at the DXY chart then. That's the weekly chart. We'll look at the daily. Interesting, really. Fundamental side, just touched upon it there. Don't fight the Fed. That's that well-known mantra, really. But markets are fighting the Fed, really. And it seems really it's getting harder to convince markets that a move above that 5% peak rate for Fed funds is actually going to be achievable. The dollar kind of looks prone to more weakness, and it's likely to be susceptible to any soft data. And that kind of reinforces the idea that there is limited scope for the Fed really to push its policy rate higher. For this week, data calendar is quite light, really. We have retail sales, industrial production, and existing home sales, but they're likely expected to fall on the soft side. So sort of backing up what markets are saying in contrast to what the Fed is saying, or at least some of or most of the Fed officials. For the dollar, yeah, we've mentioned seasonals before. Normally, seasonals are quite strong in January for the dollar. So far, not this month or not this time. And really, yeah, on a technical basis, you can see really this fall below this sort of 103 zone that we've been highlighting. and then that breakdown below there on the US CPI data. We highlighted that death cross. That's where the 50-day moving average converges and then crosses over the below, that is, falls below the 200-day moving average. We kind of said that historically, I think last week we said it tends to precede, yeah, market weakness isn't as bad sometimes with some of these death crosses as sort of makes out, but certainly it's been bad for the dollar. So the breakdown below 103 is important. The next level we have, well, we're trading on it actually. If we go to this fib level here, the at 102.32, the 61.8 fib level, that is of the dollar rally. So 102.32, we're just below there. You can see 102.30 now. So a key level, we think, there. Otherwise, more downside then sees the May 2022 low at 101.29. And then you get the sort of post-pandemic, after the spike highs, noise sort of around and below potentially 101. If we go to the daily, we can see it probably better. Yeah, there's sort of noise. Actually, bear with me. Yeah, this noise here, we're sort of thinking will offer some decent support. But we highlighted, as I said earlier, that the May 2022 low at 101.29, probably next major support for us. That's in the dollar. Okay, moving on to this week. Critical big meeting is, of course, the sorry, I'm just checking something out. Is the Bank of Japan meeting. Sorry, just had a couple of charts here actually on the US CPI. Mentioned about obviously falling energy prices being a big driver. Food and energy, food still elevated, but that falling energy price definitely helping CPI go lower than expected. Sorry, I missed out on that chart, and it just really shows you that dramatic plunge really in energy prices, really helping those inflation levels, those rampant really price pressures that we had seen fall quite sharply and beating expectations again. Okay, as I said, we should look at the Bank of Japan meeting now. Critical meeting for markets. A lot of attention is on the meeting on Wednesday. Obviously, dollar yen, that's consolidating at its lows really. The focus is all about the bank's yield curve control policy after their surprise widening in the 10-year JGB yield target band, which they moved from plus or minus 0.25% to plus or minus 0.5%. Basically, there was a local media report last week saying that the Bank of Japan would again review that yield target at this week's meeting. The report suggested the December's widening might not have been enough to address the bank's concerns over bond market functioning. That was the reason they gave for that tweak. In December, bond market functioning, and we'll talk about that briefly in a minute. The report also pointed actually to the bank raising its fiscal 2023 and 2024 inflation ex-food forecast to 2%. So that effectively signals the end of its deflation fears. And it comes at a time of much focus, certainly on a pickup in wages in Japan. We've seen that with some of the announcements by some big of the Japanese companies, and also then a more sustainable rise in inflation. But 10-year JGB yields, that's what it's all about really. So Japanese government bond yields, they continue to press actually above that new 0.5% plus or minus band, moving above that cap for a second straight session actually today. And the Bank of Japan have then been buying bonds to try and bring yields back below that. Expectations really grown then that the band will be widened potentially to plus or minus 1% over the coming months. But as we said, in spite of a lot of speculation, consensus still thinks there will be no change in monetary policy this week. And that for us is a critical point, really. Just sort of talking around this yield curve control framework, it's been in place for 7 years. Basically, the Bank of Japan pinned short-term interest rates at -1%. And 10-year yields, they wanted to fix around sort of zero. That's happened since 2016, 2015 even. And they really wanted to stimulate, of course, lending, growth, and inflation. Since then, they've loosened that tolerance for movement of the 10-year yield above or below zero 3 times. And the latest, of course, was in December, as I said, from 0.25% to 0.5%. And because yields rise when prices fall, defending the upper limits of the band has really forced the bank to buy huge quantities of bonds. And it's actually left the Bank of Japan owning more than half of the JGB market. And sort of thinking about that, then that's kind of viewed, it's kind of viewed in on bond trading, Jess, I know, as a game really now between the central bank and markets, which ultimately depends on investor confidence in the system. But the issue is then you get this sudden shift in December, just before Christmas, just before the festive period was kicking off, low liquidity, and a shock announcement like that really damaged market confidence, both in the Bank of Japan communications and also its yield curve control sustainability. And so if lots of market participants then expect yield curve control to finish, the situation kind of accelerates with JGB selling, and that then worsens the market functioning before we get to that point. And that is really the critical issue here. I think now, where are we? Well, it's unlikely. Is it unlikely? How likely is it, sorry, that the Bank of Japan does shift its monetary policy at its meeting this week? If we think about inflation, then it's probably unlikely the Bank of Japan will take bolder steps to tighten policy, really until there is that material change in Japan's inflation outlook. There's got to be real evidence of acceleration in wages. We've talked about that just a minute ago. Core inflation, it did hit 3.7% in November, so that was its highest in nearly 41 years. I mentioned about some of these big companies, Fast Retailing, which owns Uniqlo. They unveiled big wage increases, as much as 40%, I think. But generally, most economists, most Japanese economists, that is, really kind of divided on whether such moves will be sustained enough to cause a cycle of rising wages, consumption, and prices. So really interesting juncture for the Bank of Japan. I know it's also Governor Kuroda's second to last monetary policy meeting before he steps down in April. And again, that has fueled further market speculation that he could end the framework, the yield curve control framework, really to smooth the transition to the new head, the new governor, his successor. So technically, we can see these big moves in dollar yen as, of course, on the dollar side, the dollar weakening, but also then the yen being bought very heavily. Certainly, the adjustment in December was labeled as addressing JGB, Japanese government bond market functioning. But obviously, some have also read it as being the first stage potentially in Bank of Japan tightening. And certainly, again, that adds to yen positivity. So we can see technically we moved from obviously the highs in, well, 21st of October, that high was 151.94. We then had intervention to certainly today's low, 127.21. So a fall of over 16% from that high in late October to today's low, fresh low there, although we've come off that now. Each of the 3 months in the in Q4 of last year certainly brought probably reason to buy the yen. We had that intervention in October and November. I kind of stand by the fact that I kept on saying unilateral intervention rarely works. But fortunately, you kind of see that certainly they intervened at 151.94. That took the yen down, but then we did oscillate above 150 for some time. But then we got that 10th of November US CPI print, which really smashed the dollar and obviously took the dollar yen, this major down. We've seen that progressively, really. We didn't get a big move on the 13th of December with the US CPI print there, but we had intervention again, which sort of just helped that bearish momentum, really. And then you can see on the 20th of December that the tweak by the Bank of Japan really pushing prices again sharply lower. Technically, we are trading just around, you can see that 61.8 fib level of the retracement of the entire move from March last year to the high in October. That level comes in at 128.16. So we're trading just above there, really. So that will act as first support for sure in dollar yen. If we do break below that, then a complete reversal of the 2022 move implies potentially, if we look at the weekly moves down to, and I know some Japanese investment banks talking about a move down to, well, 121.70 is the next fib level, even 120 or so, which would take that entire move back. But potentially, yeah, 128.16 near-term support. And then we've got 126, actually 36, which is, yeah, the low or in, sorry, May of last year, and the low of that move there before that push higher. So interesting, really interesting levels. You've got that bearish channel that you can see, and we sort of tapped the upside at the start of Jan and then obviously moved down below that. So bottom of that channel comes in around, say, depending where you're looking, really, and where we go. Because if we move on, then we're sort of below 124. So massive meeting for the Bank of Japan. As we say, consensus still looking for no change to monetary policy, but obviously biased towards a tweak. But we've mentioned then inflation still potentially, obviously hitting multi-decade highs, but potentially is that enough to or for the Bank of Japan to tweak again that yield curve control? Certainly the bond market functioning is struggling with the Bank of Japan owning so much of the JGB market, so liquidity is exceptionally thin. So a lot of things to consider for the Bank of Japan at its meeting on Wednesday. Finally, briefly, sorry, taking up a lot of time, UK, we get that data dump. Sterling kind of taking a back seat so far this year, really. If you think about it, think about sort of September time, you know, October time. Obviously, the massive sell-off in sterling with those ructions in the pension funds, and also then obviously fixed income markets as well. So yeah, sort of much quieter, really, more favorable conditions, really, in a way. Risk sentiment certainly helping sterling, which is tied to the risk mood, certainly. But we have that important data this week in the form of jobs markets, market data tomorrow. We get retail sales on Friday, and then probably the highlight is the December CPI figures on Wednesday. Forecast to have eased again following that trend, really, in the US and the Eurozone. Annual headline print falling to 10.6%. So 1/10 lower than in November. That would make the second straight slowdown from the 41-year peak of 11.1% in October, but still elevated, still in double digits for sure. The drop in petrol prices will drive the decline. They slid close to 5% on the month against a flat outrun 12 months earlier, whilst clothing and footwear could also drag or act as a drag really due to retailer discounting. There will be some focus on the rampant food prices that we've seen after the 16.6 annual increase in November. There is likely to be some further easing then in core inflation, which trips out those food prices and energy. The year-on-year rate set to fall to 6.2% from 6.3%. But the UK still has that tight labour market, wage growth still rising at a steady pace, really, and we get that update tomorrow. Unemployment expected to hold steady at 3.7%, and average weekly earnings set to rise to 6.3% from 6.1%. And so, yeah, most survey indicators of job growth, they've kind of been slowing, but really not as much as most forecasters predicted. So that is sort of the conundrum for the Bank of England, the MPC. Last week, I think the rate hikes, there was around 100 basis points of rate hike, more rate hikes actually priced in, but that sort of softened to around 90 basis points of tightening priced in by August of this year. GDP from last week, that actually showed a stronger than expected performance for November. Which sort of points potentially to the UK avoiding recession in Q4. So a positive sign. But then, yes, we still have over sort of around 90 basis points of tightening priced in by money markets. Does that happen? We're now at 3.5% really for rates in the UK. Potentially, yes, more hikes, and certainly this week's data will probably not add to softening expectations. As I've said, wages still decent, inflation still in double digits, and really then putting the pressure on the Bank of England probably to continue tightening with a 50 basis point move in February at least. For cable, sterling versus the dollar, interesting, sort of on the daily, you can see this green candle here. So a bullish engulfing candle, really, after we tipped to sort of lows below, where were we? Below, towards below 119, 118.41, that low before we sort of pushed higher. And we've sort of got above 120 now. You've got the 200-day moving average there at 119.89 to offer support as well. 50-day moving average just above that, 120.49. And then you've got the, if we just pull out to the weekly, well, that push was off the halfway point, 50% marker at 120.52. So potentially next steps upside level 61.8 is at 124.52, which is actually that December high. That was at 124.46. So sort of upside target around and above 124 potentially if we can push above here. Otherwise, then support around 120 in cable. Finally, just look at euro sterling as well, sort of tapping that high from back in October. Interesting level there. Whether we can push up above that, then potentially we can go to potentially the October high at 88.66. Sorry, that is that October high. Sorry, and if potentially we can go above that, then we're pushing up towards 90 potentially on euro sterling. Okay, I think we've covered quite a lot, as we hopefully do normally. No questions I don't see today, but hopefully that's been clear for you and been some help for you as you navigate this week, the Bank of Japan and obviously UK data to look forward to. Please do follow us on social media, and we look forward to speaking to you next Monday. Take care.